Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment market so you can not only understand what we see out there in opportunity, but also what we see in potential risks. You know, we're an active money management firm. We run a very strict relative strength investment strategy. I'm going to talk just a little bit about that today and why relative strength has been really a proven investment strategy, not only to help reduce risk in severe down markets, but also help increase return and kind of stabilize the general portfolio. You know, there was a number of studies done by Marvin Faber about buying 52-week highs in the stock market or buying 52-week lows. And when you ask an investor, do you think you're better off buying the lows or the highs? Most investors are going to say, well, I'm probably better off buying the lows because I'm buying cheaper. In fact, that strategy has been the exact opposite of buying the highs, meaning it's greatly underperformed buying 52-week highs in the stock market. Ultimately, relative strength, what that essentially means is this. You rank competing investment sectors that are non-correlated and some that are correlated. So basically what you're doing is those sectors are all competing against each other, and the ones that are relatively stronger performance over various time frames, whether it's 1 month, 3 months, 6 months, or 1 year, has been a very good predictor of future returns of that asset category. Now again, you don't want to just look at the stock market or the stock market in the U.S., but you want to look at all economic scenarios and all asset classes. And one of the things that's very interesting is, and just to kind of go back to December of 2012, we actually own gold in our managed accounts at Resney Wealth Management. We actually sold gold towards the end of December because relatively strong it was not. It actually started becoming relatively weak. In fact, it dropped out of our top 5 sector classes, and it actually dropped towards the middle, towards the bottom of all the rankings that we do. When that basically happens, we take that asset class out and replace it with an asset class that's in that top 5 situation. What's interesting is gold now year to date in 2013, as of this video, is down around 7%. What's interesting is an asset category that we actually replaced gold with, which was the mid cap in the U.S., is actually up about 8%. So you're talking roughly a 15% difference. So what happens is it automatically, mechanically, triggered a sell in gold, and gold continued to get lower after we sold it, and it put us into a category that ranked in that top 5 category, which has greatly outperformed, of course, gold and other asset categories. So at the end of the day, owning relative strength is much better than buying things on the way down. Buying assets that are weak or going down in value, whether those are stocks, bonds, real estate, gold, it really doesn't matter, has been a proven bad strategy. So you want to go into strength, you want to own relatively stronger sectors. I've talked about some of the areas that we're in right now and some of the areas we're not. One of the areas that we're actually in is small cap emerging markets. We're not in large cap emerging markets because large cap emerging markets are actually greatly underperforming the U.S. In fact, a lot of the emerging market large cap ETFs or country sectors are actually down somewhere between 3 and 7% year to date, while our portfolio is up greatly because we're rotating into those relatively stronger areas. But small cap emerging market is actually greatly outperforming. In fact, it's up about 5% year to date, when large caps down between 3 and 7%. So again, varying sectors within a sector and is important to look at. And again, owning everything doesn't make sense, but owning those stronger sectors, regardless what they are, and upgrading that portfolio over time has been a very proven, consistent way to gain wealth, gain income, and also reduce substantial risk. The economy in the U.S., by the way, is generally getting a little bit better. The emerging market economies are actually doing quite well. Even though the emerging market economies are doing well economically, their large cap sectors, as I made a comment earlier, are not doing well. So again, there's going to be a point in time where we will own large cap emerging markets again. Right now is it. In fact, if I look at our general rankings at the middle of this month, generally speaking, gold's at the bottom, followed by long-term type bond sectors, followed by large cap emerging markets, just generally speaking. So again, we're predominantly in small cap emerging markets. We're predominantly in U.S.-based various sectors, whether small cap, mid cap, and large cap. In our income side of the portfolio, we continue to stay away from long-term general bonds like treasuries and munis, which have been, again, exceptionally weak this year. We continue to own mortgage-backed REITs, real estate investment trusts that are basically in mortgage-backed securities. We continue to own global bonds, emerging market bonds, and high-yield emerging market are a few of the areas. And they've actually done exceptionally well this year. So again, staying out of relatively weaker income areas like longer-term intermediate treasuries and muni bonds, and basically going into income areas that are truly giving our clients a reward and actually making a return on the money. I firmly believe that the economy over time will continue to get a little bit better in the U.S., and I firmly believe there's a lot of investors out there, of course, non-clients, who are greatly either underperforming or taking substantial too much risk. I had a workshop last week, and a workshop, by the way, when we do a workshop, that's a paid event, so people actually will pay to come hear me talk about the economy and the markets, and it's extremely educational. One of the things that I left every one of those listeners with, the biggest risk investors have is not having an actual investment strategy in writing that's followed consistently. And I see this over and over again. We literally have thousands of people that sign up for our newsletters and our videos. And when I talk to people in this workshop, not one person in that workshop raised their hand if they actually had an investment strategy in writing that they were following. These were some do-it-yourself investors. These are people using the brokerage houses. Of course, they don't manage your money either. But at the end of the day, if you don't have an investment strategy, you don't follow it, you have no chance or little chance of any kind of success, and ultimately you take more risk. That's why our clients hire us to manage their money, provide upside potential, income, and more importantly, protect against major catastrophic loss. Of course, if you're not a client and want to become a client, call our office for a consultation. If you're a client and you have questions about your portfolio, give our office a call. We always like talking to our clients and making sure your questions are answered promptly and correctly. Make sure you have yourself a very profitable week. And by the way, for those of you who were unable to watch my live TV show last night, it is in our media center in our website. So go to ResonatWealth.com. You can watch last night's half-hour live TV show with, of course, me, the host. Have yourself a safe and profitable week.